probably heard it 1,000 times. Keep your credit score high. But have you ever asked, why? Why is your ability to get a loan more important than your ability to build wealth? Let me tell you about Michael. He's 32, has never missed a bill, earns well, owns his house, and has no debt. Yet, when he applied for a car loan, he got rejected. Why? Because he had no recent credit activity. That's when it hit him, and it might hit you too. The credit system doesn't reward financial responsibility. It rewards debt. Today, we're diving into how the credit score system really works, why it exists, who it benefits, and how to play the game without getting trapped. A credit score is a 3-digit number that supposedly represents your creditworthiness. In the US, it usually ranges from 300 to 850. It's calculated using data from your credit history, how much debt you have, whether you pay on time, how long you've had credit, what types of credit you use, and how recently you've used it. It sounds like a logical system until you look closer. If you pay your rent on time, keep a budget, or buy a car in cash, none of that helps your score. But if you carry credit card debt and make minimum payments, that helps. Not using debt at all can actually lower your score. It's as if the system is saying, "We trust you more when you owe us money." Why? Because credit scores aren't about responsibility, about risk and profitability. The credit bureaus, Equifax, Experian, and TransUnion, they don't work for you. They work for the lenders. They've designed a system that classifies you not by how good you are with money, but by how well you feed the lending machine. This is why things like paying utility bills, rent, or even taxes on time don't help your score, because no one profits from that behavior directly. It's not about trustworthiness, it's about how useful you are to the debt ecosystem. Let's get brutally honest. The credit score system is designed to keep you in the game. Think of it like this. If you're debt-free, with savings and no recent credit activity, the system punishes you. But if you're constantly borrowing, managing, not eliminating your debt, you're rewarded. This keeps consumers in a loop. You borrow, you repay. You borrow again, maybe pay a fee or two. But as long as you're consistent, your score improves. It's like a treadmill. You're running constantly, but going nowhere. And here's the scary part. Most employers, landlords, insurers, they all use this number to judge you. Not your values, not your skills, a number based on how well you play with debt. Michael, our friend from earlier, lived debt-free for 5 years, paid everything in cash. But when he tried to get a phone on a monthly plan, he was rejected. Not because he wasn't reliable, but because he wasn't visible. To the system, no data means bad data. In fact, some lenders call people like Michael credit ghosts. And in this game, ghosts don't get approved. Credit invisibility is a real and growing problem, especially among younger generations who prefer to avoid credit altogether. The irony? The more responsible you try to be by staying out of debt, the harder the system makes it for you to succeed within it. And yet, this isn't just about credit. It's about control. The system isn't broken. It's functioning exactly as designed, to reward those who participate in debt cycles and penalize those who don't. Take Sarah, for example. At 27, she had never taken out a loan. She paid rent, utilities, and insurance on time. But her application for a small business loan was rejected because she had no credit history. So she did what many do, took on a credit card, carried a small balance, and started playing the game. 6 months later, same bank, same loan request, approved. It wasn't that she became more responsible, she became more predictable as a debtor. The credit system didn't evaluate her based on integrity, income, or discipline. It evaluated her based on how well she simulated debt behavior. There's also a psychological layer here. We're trained to see credit scores as our financial identity. A low score makes people feel like failures. A high score feels like success. But both are illusions. You can have a great score and be drowning in debt. You can have a low score and be totally financially free. Let me give you a simple analogy. Credit scores are like GPA for borrowers. But a high GPA in borrowing doesn't mean you're good with money. It means you're obedient to a system. It trains people to believe that being creditworthy is more important than being wealthy. Ask yourself this: if tomorrow you lost your job, which would you rather have? A high credit score or 6 months of savings? Exactly. And here's another twist. Many people obsess over improving their score just to take on more debt. That's like trying to lose weight so you can binge eat again. Okay, so we know the system is flawed. But if you still need to function within it, there's a way to play smart. Use a credit card for recurring expenses like subscriptions. Set up autopay and pay the full balance every month. This shows activity without risk. Don't close your oldest credit card even if you don't use them. Credit age helps your score. Keep your credit utilization low, ideally under 10%. This tells the system, I have access, but I don't depend on it. Request credit limit increases periodically. That lowers your utilization rate, which can boost your score without taking on more debt. Mix your credit types carefully. Having a credit card and a small installment loan, like a credit builder loan, can help improve your profile. Consider using tools like Experian Boost or reporting rent to credit bureaus to help add positive activity without borrowing. And if you're rebuilding from a poor score, start small. Get a secured credit card, use it wisely, and build up gradually. But, and this is key, never let the score dictate your decisions. The goal is freedom, not obedience. Imagine if we taught kids how compound interest works, instead of how to get a student loan. Imagine if your financial worth wasn't tied to how many payments you've made, but how much value you've created. This shift in mindset is what separates people who become wealthy from those who stay trapped. They don't chase credit, they chase control. They build emergency funds. They invest early. They live below their means. And eventually, they stop caring about their credit score altogether. Because when you truly control your finances, you don't need approval. You already have freedom. Let's flip the narrative. Instead of asking, how's your credit score? Let's start asking, how's your financial peace? Your credit score isn't your identity. It's just one number in a system built to serve lenders. Use it if you must, but don't worship it. Don't let it define your self-worth or your strategy. The real flex isn't a perfect 800 score, it's financial independence. If this video helped you look at the system differently, hit like, subscribe, and share it with someone still stuck in the credit trap. And tell me in the comments, what's one thing you've done that helped your finances but hurt your credit score? Let's expose the contradictions together. And remember, it's not about playing the game better. It's about learning when to stop playing altogether.